Hello, this is Abhilash Jaykumar, co-founder and co-CEO of Trust Vista. I'm very excited today to have the who's who in the secondaries world joining me today to have a conversation about the state of the secondaries market. Very quickly, I'll let my panelists introduce themselves. Jan, if you'd like to kick us off.
Sure, Jan Robard, managing partner at Dawson Partners. We are a global asset manager focused on providing custom liquidity solutions for LPs and GPs based in Toronto, 20 billion under management.
Yeah, my name's John Kepnick, Stepstone Group. We are a global asset manager and advisor, really just focused on the private markets, about 700 billion in assets under advisement and management.
Nigel Dunn, head of private capital advisory at Evercore. We are an advisor focused on both the GP and the LP parts of the market and structured solutions like CFOs. We're 130 people. And we're in the US, Europe, and Asia.
Anthony Chance, global head of our partnership investment team at Partners Group. Partners Group is an asset manager, a little over 150 billion AUM, focused on private equity, credit, infrastructure, and real estate.
Thank you. Maybe we can start the conversation about the past and how we got to where we are today. Every year when we have this conversation, it seems it's been quite transformative in a short amount of time. Anthony, maybe I'll start with you and love to hear your perspectives of the recent past and the longer tail of how we've gotten to where we are.
Ooh, the longer tail. How much time do you have? The secondary industry has seen consistent growth up and to the right. Volumes. The LP universe is by now pretty familiar with how secondary works. GPs are embracing the ability for their LPs to transact, and that has led to continued growth in volumes. The trend to kind of split or bifurcate the market into GP-led and LP portfolios started 10-15 years ago when we started to see team spin-outs and portfolios, carve-outs, but that really just took off over the past 5 years as GPs embraced that and realized the power of compounding and being able to hold on to their winners, their best assets, rather than selling to a competitor. And that's what's driven a lot of the growth in the secondaries market over the past 5 years, and now we're at a point where those two components of the secondary market are very different players, different skills, different transaction dynamics, and I'd love to spend some time kind of drilling into each of those today.
Yeah, and John, would love to hear your perspective on the same.
Yeah, sure. I think there's a lot of people who are really excited about the secondary market today. I think it's you can't read very long before you come across some article about secondaries, but I think the reality is the market's been around for a long time. It's been doubling every 5 years, and today I think there is a true catalyst for that rate to increase. I think there's a much larger opportunity set out there that the secondary market could grow into, but it's not a new phenomenon. It's been happening for quite some time. I think it's just broader public perception, and I think LPs are catching on to just really the opportunity set within the secondary market. So certainly an exciting time to be a secondary investor, but I would argue it's kind of been that way for quite some time.
From the top of the mountain for a while and been a leader in shaping the perception of the secondaries in the market. So, go.
Yeah, so here's my thing. So the way that I like to describe the secondary market is 3 chapters, and it feels like a lot of us on this video here have been in it for a really long time. Most of us for 25 years. It's been incredible, and every year we talk about, oh my God, the secondary market, it's growing, but it's just beginning. I like to break it down into 3 chapters. Chapter 1 was 2001 to 2011. That was the decade of institutionalization. The secondary market went from 5 billion to 25 billion during that period of time. And it really was just focused on LP secondaries. There wasn't much innovation in that particular part of the market. Then chapter 2, from 2011 to 2021. That was, in my mind, in our minds, the decade of innovation. We went from just having LP secondaries to having levered LP secondaries single asset GP leds, multi-asset GP leds, private credit secondaries, real estate secondaries, infrastructure secondaries, preferred equity, NAV lending. Let's put GP stakes in there. I mean, that's all happened in 1 decade. And during that period of time, through all that innovation, the secondary market went from 25 billion to 125 billion, another 5 times increase. So in 2021, we believe we've entered the decade of capitalization in the secondary market. With all of that innovation, what happened was that the secondary market, in our minds, it became vastly undercapitalized. You have so much pent-up liquidity, you had so much innovation in that. And what we're finding is that certainly already in a third of the way through this particular decade, we're finding pockets of opportunities for the market to capitalize, whether it's institutionals that are stepping up in their allocation, or whether it's private wealth that's really kind of stepping into it, which will be a big driver of this. But what's crazy about this market, for as much, I lose my mind on this. Every time I see a headline that says, oh my God, the secondary market, largest fundraising year ever, what's missing in that context is how much has been deployed in that same year. Every year since 21, more capital has been deployed than raised. We have deployed $425 billion and raised $275 billion. This is a market that is vastly undercapitalized. And when a market is undercapitalized, generally speaking, historically, you would suggest that that's when it gets capitalized. So we do believe, and we have a big prediction, that the secondary market will get to $1 trillion by 2031. It has been received with a lot of skepticism. I can appreciate that. But at the end of the day, from our perspective anyways, we're well on our way. And this year, we'll talk about it. It's going to be a record year.
Just maybe if I could chip in there, and John and Anthony are smart, because in terms of webinars, you generally don't want to follow Jan. But I think he's true. One thing people forget about the secondary market is it's going to be a record year this year. And a record year may be 150, 160 billion. However, that is still maybe 2% of the embedded private market AUM. It's tiny. And so I think Jan's point and what we're all feeling is that, this market, the secondary market, is a strategic tool to deploy capital for both GPs and LPs. And what happens naturally in any market is you get specialized over time. And what Jan was saying, you specialize in debt, you specialize in infrastructure, you specialize in private equity. And each of those markets, as they have grown on the primary basis, the secondary market will kick in. So while we all used to be in the backwater of private equity, where they didn't used to be a spot on conferences to talk about secondaries. Now, we're in the unusual position of being in the captain's seat on some of these conferences. And if you think about the public market and how much is secondary versus primary versus the private markets, we're never going to get to those sorts of levels. But it wouldn't be unusual to get to 3 to 4 to 5% of embedded AUM, which then the sort of projections I think that Jan was suggesting are not crazy, as we think about growth. Anyway, can I go before Jan next time?
I'm gonna make your job easy, because I'm just gonna keep going on a couple more points. So first of all, what I find fascinating about the secondary market, what is its role in private equity? One of the things that in 25 years of doing this, what's obvious to us is that private equity has outperformed public markets. We look at 5, 10, 15, 20-year data. We cannot see a period of time where private equity hasn't outperformed public markets. In 1 to 3 years, there could be valuation timing lags that create idiosyncrasies, but actually over the medium and long term, it has. And the reason behind that has been the governance model of private equity. You have essentially long-term capital that can build a better business. We believe public markets are broken. Private equity is the right governance model. When you look at public markets, you've got people, 70% of the market is computer traded. The 30% that isn't, there's about maybe 5 to 10% that's actually looking at the fundamentals. And when they do, they look at quarterly earnings. How do you build a better business focused on quarterly earnings? Private equity has patient capital. It has concentrated shareholder base, aligned, but they need that 3 to 5 year capital in order to do that. On the other side, there's LPs. They have built their portfolios in different ways, in different markets, and it's reacted differently And so they need to tactically reallocate their private equity portfolios. And that's what the secondary market does. It sits in the middle and essentially doesn't disrupt the ecosystem. It allows the GPs to have that patient capital, the 3 to 5 years, and it allows LPs to do what they need to do with their portfolios. So when you start looking at it from that perspective, and to your numbers, Nigel, like we were 5 trillion in private capital in 2016, we went to 15 trillion by 2021. Bain has it going to 60 trillion by 2031. That means that only less than 2% of private capital has to trade for us to get to $1 trillion. Okay, I'm gonna breathe.
Yeah, you need to pause, yeah, because I'm gonna challenge the assumption on the trillion.
I love this.
I challenge the timing, first of all, because I think we're already there. So here's the thing. People try to put secondaries in a box and say this is the market, this is what it is. The truth is the lines have gotten very blurry. You know, a secondary buyout, sponsor to sponsor, is that a secondary? A secondary direct, buying shares in a pre-IPO company, that's a secondary. There's a lot of leakage in the secondary industry of other things that are adjacent. NAV lending. A lot of LPs are learning that it's not always the best thing to sell their portfolio. Maybe a financing makes more sense. Maybe a securitization makes more sense than a secondary sale. So this entire universe of liquidity is already $1 trillion. So I'm not even sure how you got the invite to join this call, because you're not a secondary investor, right? Your track record is not in secondaries. You're a structured finance provider.
Right. Wow, there's a lot going on there, Anthony. I appreciate that. So first of all, yes, the definitions of secondaries as an industry, we're going to have to define it. But if I look back to like traditionally what has been, in Nigel's studies around like what is the size of the secondary market, it can grow through innovation over time. But the traditional definition today is at 150 billion. And if you use that traditional definition, can it get to $1 trillion by 2031? That's really my question. I think that you're right. There has been innovation that has allowed the funnel to grow. And look, we think we operate within the secondary ecosystem, because what are we doing? We're accelerating liquidity on private equity portfolios. We're allowing people to keep the upside and the flexibility in doing so. But what you're really doing is injecting liquidity in an otherwise illiquid asset class. And I think that really is the role of the secondary market, so that essentially LPs are able to tactically reallocate their private equity portfolios. What I find amazing is, like, imagine you bought a public market portfolio, you did nothing with it for 10 years. Boards would probably say that's fiduciarily irresponsible. But the reality is that that's what's been happening in private equity. People commit and hold to private equity and they do nothing with it. The secondary market over the next 10 years will allow LPs to be a lot more sophisticated in how they're managing their private equity books. And that's the driver. Oh, Abby wants to ask.
When you talk about the evolution and where we are now, I remember a time when people didn't use the word industry for private equity, right? And it became an industry. And part of becoming an industry is not just talking about the businesses they invest in being better businesses, but the asset managers themselves have evolved in how they function. And what we're just touching on here, the specialization within the secondary world. What is the definition of secondaries? I'll direct it to you, Nigel. You sit in the middle of this ecosystem, and you have been doing this for a long time, and you probably have one of the largest advisory teams on the planet, not just in secondaries, in anything, right? Where is the institutionalization happening currently and in the near future, as this is becoming a very clear industry?
Yeah, I think there's a few things that are really changing right now, and bringing this as an institution. I think one thing is just the growth and maturity of retail and high net worth, because I think when an industry moves into Main Street from Wall Street, then I think, and the familiarity more generally, and in a sense, the democratization of private markets, where individuals who are not part of a big pension fund can now participate in this market, that's when I start to think of becoming institutions. In the same way, if you have a Schwab account, you can buy public stocks. Now you can, with a Schwab account or another online broker, you can actually click into private markets. These are fairly material developments that will fuel the growth of private markets, in addition to the other parts, the sovereign wealth funds, the pension funds, other, aggregators. So when I think about, the institutionalization of private equity and the secondary market, that's how I think about it. And then, maybe peeling that back a little bit, it is a strategic tool now for GPs, which I think if we think about Jan's first example, we went from LPs. The motivation 20 years ago was either distress or regulation. The banks were selling, used to be 40% of the LP market, or there was distress. And now it's a strategic tool that is used by both GPs and LPs. And for GPs, and I think Anthony touched on it as well, this is a legitimate exit option alongside, a strategic sale, a public offering, a sponsor to sponsor, and in the form of what continuation funds want. I just look at a continuation fund as a sponsor to sponsor transaction. It's just the same sponsor as opposed to selling to a different sponsor. And the question is just, what's the price? And in some ways I think about continuation funds as part of that democratization, because everyone in the selling LPs base gets exactly the same question. No matter if they're $1 million investor or $1 billion, do you want to sell? Do you want to participate? So in other words, it's taking some of the inefficiency out of private equity, and the inefficiency being a 10-year fund, which is a little bit of an anachronism right now. So, when I think about institutionalization, it's innovation that creates efficiency in a less efficient market. It is who participates and who can participate in that market. And some of these structures really getting fixed in and being legitimate, from, in the sense, structures which were evolving a few years ago to, we have these vehicles, continuation as an example, which people accept, or an LP realizing there is a liquid market and they have options if they want to exit. And the options, I think, as Jan touched on, you can sell a position, you can finance a position, you can securitize a position and using a public market bond option. So you have all these tools that you just didn't have before. So it's that, sophistication. It's who the buyer is, and accepted structures.
Look, just thinking about just how we built our business, right? And it kind of really touches around those key themes of specialization, right? I completely agree with the $1 trillion goal and, the trend towards specialization. But you think about, 20 years ago, how different the market is today, right? StepStone, as I think about our business, we have dedicated products for buyout secondaries, growth secondaries, venture secondaries, real estate secondaries, infrastructure secondaries, private debt secondaries. We have long-term, private equity structures, 10-year lockup, 10-year life fund structures, where, kind of the roots of the industry. We have 40 Act option, semi-liquid products across all of those. So the industry has grown a ton and become much more specialized over those years. To me, the big impediment, though, to kind of get to that $1 trillion number is really just around fundraising. I think, we've raised a ton of capital, as has, Anthony and his team and Jan, but I think the reality is there's a shortage of capital out there, even still, and pushing. Actually, I think, Nigel, your team has done a good job pushing into kind of new sources of capital, right? LPs kind of coming into GP-led transactions, more, regularly getting syndicated out pieces of deals. But I still think that's the biggest impediment to us kind of hitting that $1 trillion mark, is just, the fundraising capital out there.
Yeah, and obviously the secondaries market has grown as, the underlying private equity market has grown. But I think going forward, private equity is also going to depend on the secondary market to grow as well, as a tool that supports more private equity LPs coming in to create that liquidity. So where does the capital come from?
I think there's a part of it that the institutions have been taking more and more notice of the secondary market. So there's an organic growth in terms of how much capital will come through kind of the institutional channels. I think Nigel and his team has been kind of leaning forward in terms of structured products and some of the ways that people can access it in different ways. And I think the third pillar is private wealth. And I think that, look, I mean, put some numbers around private wealth. There's $150 trillion of assets under management. 2% of that is allocated to private equity. That's $3 trillion. Institutions put 10 to 20% of their portfolio into private equity. So if you think about that, the numbers are 15 to 30 trillion minus the 3. You've got 27 trillion dollars coming into private equity through that channel. I know over what time that will be TBD, but that's going to feed to a certain extent this market. And by the way, the secondaries market, because they're highly diversified portfolios with diversity around kind of historical vintages, is an interesting way for high net worth individuals and private wealth to access the secondary market. So I think there's a 3-part process as to how this will get capitalized over the next 7 years. And I think, look, whenever you put a big number out there, people are always a little bit skeptical. But I think historically, if you would have asked somebody back in 2011 if it can get to 125 billion by 2021, people would have said no way, and it did.
Yeah, I think maybe one thing to add on is that secondaries is a quintessential scale business, in the sense that if you're raising a US buyout fund, you can do US buyouts. If you raise a secondary fund, you can invest in any vintage and any geography and any strategy. So given all that, a secondary fund should be a multiple of any primary fund. So when we hear these large funds being raised these days, to me it's absolutely not a surprise, because when you have the market has developed to this level, you do have more of a liquid market, and people can look at opportunities on a relative value basis, which I think we haven't seen traditionally. But you can trade out of old vintages, you can trade into new vintages, you can do all that. And in a market where I think LPs can feel it's fair, they're getting a fair price, and there's sufficient transparency. So I'm kind of with, I think, you all on this in that, it surprises me that, or it would not surprise me, I should say, within sight of a $50 billion secondary fund or a $50 billion secondary program. Just because you can, like if you just take on the GP side, anyone on this call can walk into any GP in any geography and said, I'd like to partner with you on that asset. And as a secondary investor, you're a partner. You're not a competitor. And so you have a unique access to the best companies in the world, where if you're a buyout fund, they may not want to sell you their best company, but they'll want people on this call, they'll be more than happy to partner with you.
I just want to come back to the point on the retail investors, though, because that is such a seismic shift in our industry right now. And 20 years from now, this analyst out on the floor here, he's going to be in my seat running our firm. Bobby, one of your analysts, is going to have a panel with him and say, you joined private equity when they still had limited partnership structures. What was that like? Like the evergreens, the retail channels, they're just a better structure for private equity. The 40 Act, we talk about these 40 Act funds. 40 Act, it's 1940. Like, that legislation is so ancient. It was written at a time to protect investors from speculative behavior. And venture capital, private equity, was speculative. Now the tables have turned, right? If you want to speculate, you invest in public stocks. The FANG stocks are a significant portion of public equity that's traded. If you want to invest in real businesses that drive the economy, you invest in private equity. And so the legislation needs to change. There need to be not just 40 Act funds, but other vehicles that 401ks can access, that your everyday investor on Main Street can access. Right now, they're disadvantaged because they can't access private equity. And that will change. That will change, and that will open up a lot of new capital for secondaries as well.
Yeah. Jan alluded to the capital in the private markets. John, you touched it as well, and Anthony, you've spoken it. So what can happen in the near term to start unlocking that capital? Maybe John, if you like to speak on that.
Yeah, in terms of what can happen in the near term to unlock additional capital. Look, I think there is just broader adoption across kind of new types of LPs, right? So I think the biggest wave we're seeing right now is probably the 40 Act capital coming in. On the institutional side, I do think you're seeing people, as Jan said, kind of increasing their allocation. And so, from our standpoint, there's a good tailwind to the industry for sure. I'm just questioning how quickly we can kind of get to that $1 trillion number.
Yeah, look, I think, it's no surprise to anyone that private equity over the last few years there's been a dearth of distribution. Like any market out there, private equity has gone through a bit of a cycle, and through that cycle, LPs essentially got over allocated to private equity. It started in 21, yeah. Their portfolio did too well in 21, and they started 22 over allocated, and then public markets declined, that compounded over allocation, and then 23 distributions dried up. And so what needs to happen in private equity is there needs to be a bit of a flywheel effect where you get distributions and you can reinvest those distributions. So there's been in the market generally, this dearth of distribution has reduced the amount that people can allocate to private equity and to secondaries. What we're seeing right now is that we are seeing private equity super cycle begin, where liquidity is going to return to more normalized places, and where actually private equity is well placed to outperform public markets over the next couple of years. And as that liquidity returns, look, inflation has crested, interest rates has peaked, bid-ask spread has narrowed, the political, the election is behind us now, and what we're seeing is that deal doing is coming back. As that comes back, then there's a flywheel effect of the distributions come back, and these institutions can start reallocating to private equity generally and secondaries more specifically. So, anytime there's a period of volatility, if you think back to 2009, secondary market was the lowest ever in 2009. But what it did is that it educated the market generally as to what are the tools in the tool set in order to really kind of create a boom in the secondary market over the next 10 years, because this is not a rainy day strategy. People are always looking at ways to increase sophistication in how they're managing their private equity portfolios. What happened in the last couple of years is a vast amount of education around private equity and the different tools in the tool set in the secondary market that will again create this big boom in the secondary and create a lot of growth, because those tools are not just used during bad times, they can be used during good times and bad. One last statement, in 2021, that was the biggest year ever in the secondary market. It was also the highest liquidity year in private equity in the longest time. So people that think that pro secondaries is there just for when things are hitting the skids, it's not true. In good times and bad, secondaries is growing.
The only thing I was going to add to that, in 2009, you're right that volumes dropped off a cliff, right? I think it's been different this time around. This is actually a longer, more prolonged period of dry distribution. You think about like the last 3 years, we're at roughly about half of a typical year in terms of distribution pace. In 2009, we saw 2 years of dry distributions. Early 2000s, we saw about 2 years of really dry liquidity. Today, we're year 3, right? Venture, I think we're seeing kind of the lowest distribution pacing since 2000 today, down 75% from 2021, right? So massive decline in distributions. But what you're seeing a little bit different this time is you're still seeing a very, very active secondary market. But I agree wholeheartedly, and even to put some numbers around it, and I do think we've turned the table. I think if we just kind of scrape our clients, right? StepStone has a massive client base. Looking across our clients, we've received about $28 billion of distributions just in the last year. And I kind of compare, I look at that month over month, week after week, how is that pace changing? And we're up about 50% relative to the prior year period. So we have seen that pace of distributions pick back up. I don't think you see that in the broader data looking at, annual trends just yet, but it is coming. And I feel like the next few years should be a great time for private equity, and especially for secondaries.
Yeah, maybe just finish with one point. If you just zoom out of the market, right, it is back to Abby's question, is like, how do you get more capital into this market? I think that most financial markets, how you get more capital in ultimately is by reducing friction in entering the markets. And the example would be the derivatives market, for example, when you got standard ISDA documentation where you click through documents to trade. If standard documentation became part of the secondary market to make it easier to trade, then you will see a material and natural increase in volumes. If you think back on the FX spot market, that used to be a telephone market. When you take the friction out of it, and for example, a lot of the FX spot market moved on to FXall, or government bonds moved on to TradeWeb. When you take friction out, then volumes tend to explode. And I think that the example Anthony was giving on 40 Act funds is basically you're taking the friction out of investing in private markets as an individual, because you can click rather than signing up to a 10-year fund and capital calls and all this all this paraphernalia, which is a figment from the past. So reducing friction overall over time brings more capital in because it's easier to transact in the market.
And Nigel's been actually quite an innovator in removing friction. Like when we all started in this industry, you had about a month between indicative bid and binding bid, and we moved at a very different pace. And at some point Nigel said, "Hey, can you just come back in 48 hours and confirm that bid?" And he's been pushing the pace, and now it's often there is no two-stage process. It's like, hey, this is the price, and we're not quite at the point where you click buy and then it takes you to a link. Oh, here's the purchase and sale agreement, sign it, boom. But we will get there, and technology is contributing to that innovation. The growth of the market is just accelerating the pace, and that it's removing some of that friction.
Yeah, I was like, again, I'm trying to be mindful of not taking too much of the airtime, but it's actually interesting, John. Like, so we did a study and we looked at the global financial crisis versus this crisis, and we said to ourselves, so I agree, venture and growth, absolutely, distributions continue to be very low and will be low for a while, but actually it's uncanny how similar the global financial crisis has been to this crisis. So we looked at 2007. If you had $100 in private equity, you got 40% of it back that year. It was a high liquidity year. It was the peak before the crisis. In 2008, it was 20%. And in 2009, it was 9%. Yeah, it fell off a cliff. Look at 21, 22, 23, 43%, 20%, 11%. This is buyout.
But we were 9%. We were 9%. Yeah, exactly.
Yeah.
It's uncanny.
We're underwriting like.
What happened in 2010? 27%. I don't think 24 is going to get to 27%. To your point, I think it has been a longer cycle. I think last time it was 12 months. This time it's more like an 18 to 24 months. I think the second half of 24, you're starting to see going back to on average 25. But if you have a bad first half and an average second half, you're probably about 15 to 20%. And then as you kind of enter 25, and because the flywheel is back in deal doing, will we see 25 as on average year distribution, say 25%? We think so. We'll see.
We think so too. Look, we've seen lenders become much more aggressive. Lenders are back. They're facilitating M&A activity again. We think distributions are back. And then when we talk about the continuation vehicle, we're not even close to a tipping point there, right? There's still some friction there. Over the past couple of years, we've seen, valuations that a lot of buyers have struggled with, pro forma adjustments. But now, over the course of 24, we've seen those companies grow into those valuations. You don't need those pro forma adjustments anymore. The public equities have run up way faster than private market valuations, despite superior earnings growth in private markets. So we do feel like the floodgates are about to open, and 24 will certainly be a record year, but 25 will be even bigger following up.
Nigel, you had previously said that secondaries partner with the GPs, not competing with them. Can you maybe just speak on the competitive dynamics within the secondary space and how you see that evolving on our march to $1 trillion?
I mean, as I see the buyer group, it feels to me the development is like most industries. And in some ways we're in early innings, right? In that the big will get bigger. And I think we can see that with many of the publicly quoted groups who are scaling up very, very quickly. And part of that scale up is type of investor you access, amount of permanent capital you benefit from. And the value in scale in the secondary business I think is material. Then I think you get groups who are real specialists. They specialize in an asset class. Now you have specialists in venture, in private debt, in real estate, in infrastructure, whereby those markets are sufficiently large and growing to support a specialized group of buyers. Generally, where you don't want to be in any market is, as it develops, is sort of undifferentiated middle, where you're almost too big to reach down, too small to reach up. And I think you already are seeing consolidation in the market. This is probably in asset management, this has probably been one of the most vibrant M&A markets over the last few years, because I think a lot of the groups who have traditionally accessed individuals with traditional products are realizing that you actually have to. I mean, if we're 50% right on volumes, if you're a large, publicly quoted asset management and you don't have a strategy to access this market, it's almost a dereliction of duty. So when I see specialists in continuation funds, and there'll be specialists in continuation funds also, because clearly for certain general partners who source a material amount of their deal flow from other GPs. So the sponsor to sponsor market, material market, wasn't 15 years ago, is now. Therefore, for you to defend your position and still deliver those sorts of companies to your own clients, then you need to think about setting up a specialist vehicle. So we have specialist vehicles in all aspects, which I think is a natural and healthy development of any maturing market.
And thinking about competitive dynamics, Jan, I was going to turn to you. Obviously, you've been an innovator in this space, and as Nigel was talking about differentiation, I'd love to hear your perspective on the competitive dynamics.
Yeah, look, I mean, I think that this is what's really interesting about the secondary market. Imagine you're a primary investor and you say, I'm going to go and benchmark my, mezz fund up against my venture fund. You wouldn't do that. Like in the primary buyout space, we have disaggregated to mezz, to middle market, to large, to mega, all the way up the screen. And what's going to happen, I think, in the secondary market, and it's beginning to happen now, and Nigel does a great job in terms of showing kind of returns on continuation vehicles as an example. There are different risk returns within secondaries. A single asset transaction is not the same as NAV lending or pref or LP secondaries or levered LP secondaries. And so what's going to happen over the next 5 to 10 years is that as it gets disaggregated, people are going to benchmark the different strategies because they're all different risk returns in different ways. And so it's no longer like, oh, let's put a secondary up against a secondary, because it could be pref versus single asset. That doesn't make sense, right? And so that's the sophistication. And then LPs, they are able then to pick what do I need in my portfolio? What's the risk return that I'm looking for? There's no strategy that is better or worse. They're just different risk returns. And then you pick the strategy you want in that risk return. And then you go and figure, okay, well, which manager is going to be the best manager to deliver on this particular strategy? I think that's the evolution of secondary over the next 5 to 10 years.
Wonderful. In the interest of time, maybe would love to just get each of your closing remarks on, where we go in the next 5 and 10 years. And I know, Jan, you have a vision of $1 trillion, but maybe what's that curve look like?
I'm starting. Yeah, I mean, like, look, it's interesting because people have been asking me, particularly over the last couple of years, like, because we started talking about this $1 trillion a couple of years ago, and they're like, well, do you still have conviction? Because 21 was our record year, and then 22 and 23 kind of softened a little bit. But what you're seeing is 24 is going to be 150 to 175 billion. And by the way, in 2019, I said that the secondary market could hit 200 to 250 billion. It's in the Secondaries Investors article, and there was a lot of skepticism. There was a lot of people laughing about that prediction, and lo and behold, we'll see what happens next year, but we're getting pretty close. And so I think that from my perspective, this is just the market. Like, we're 25 years into this market and we're in the bottom of the first.
I think we will continue to see the lines being blurred between sponsor, secondary investor, lender, right? Solution provider, liquidity solution provider. I think the biggest change over the next 5 years will be embracing different forms of liquidity, whether it's a securitization of your portfolio, whether it's a NAV loan, whether it's a secondary sale. And then, as I mentioned, with the continuation funds, we're not at the tipping point. It's going to explode, right? Once you have a scenario where you can have a conversation with one or two parties that can step up for $2 billion, then sponsors are all of a sudden really interested. Right now, I think everybody understands the continuation fund market. Most sponsors have done one. There's still this notion, though, that it's an alternate exit route. It should not be an alternate. It should be mainstream. In every company, you should evaluate, is a continuation fund the best exit path? Is that the best thing for the company, for the investors, for all the stakeholders? And there's still this notion that every GP can only do one or two per fund. And if you do more than that, then you're kind of pushing the limits. So I do feel like it's we're going to see continued innovation and just a real blur of who is a secondary investor and who is not, because the forms of liquidity can take a lot of different forms.
As I think about kind of the road ahead, I agree. I think the market's going to grow, no question. I agree with Jan's forecast. I always have, Jan. So I'm bullish on the industry in the same way that you are. I think the industry will continue to specialize. And the one thing that hasn't been said here is I actually think you're going to start to see a lot more differentiation of returns, right? When you think about more and more people moving into single asset transactions, and Jan, you touched on this, just the risk return nature of secondaries. I think people have historically looked at lowest volatility of returns in secondaries across all of private markets and similar returns to buyout. That is a recipe for phenomenal risk-adjusted returns. I think you're going to see more volatility as people move into more concentrated positions, and I think you'll see that play out as just people who do really well and people who don't. And I think that's a good thing. That's a healthy thing for the industry, for people to have to really fight to raise capital and to perform. And so the other kind of things that will differentiate a lot of that for me is access, size and platform. Nigel touched on just the size and scale of the larger groups, I think will be key. And then, just you think about like technology, right? How are people kind of innovating and using technology? The speed of execution is changing. Anthony touched on that, but what can really make a difference for a lot of us in kind of getting up to speed on a transaction, a lot of that comes down to technology, using groups like yourselves and others to really kind of help make us more efficient in our decision making. So, I think that will be another kind of key differentiator when we think about how the market changes over the next 5 years.
Yeah, that's a really interesting point. I just want to point out, like, the standard deviation of secondary returns historically was low single digit, kind of 8-9% standard deviation. If you look just at the past 5 years, that blew up to 15% already. So we're already seeing that bifurcation, and we'll have winners and we'll have losers.
I think I would agree with what's. It's hard not to be bullish on the secondary market, and I think, like with any, outlandish prediction, which Jan, I think there was a view that that's a crazy prediction. Any big prediction starts is crazy. And then it's highly improbable, and then it's possible, and then it's likely, and then it's inevitable. And I think the arc in the secondary market will track, will track that. And we will look back and we will say that this is a market, sophistication will increase. And specialization, I think, you can break it down further. I'm pretty confident you'll have specialized secondary healthcare funds, specialized secondary technology. How can you not when it's 50% of the market? And then you are likely to break down within secondary healthcare services funds, because people will want very pinpoint exposure. Whereas now, if you invest in a secondary fund, well, isn't LP secondaries all the same? Absolutely not. There's a lot of differentiation. So I think that increases and that drives innovation. It drives capital, and it drives the growth and sophistication of the industry.
Okay, one closing remark in all this. I think for me, my ask is, as people think about coming into the secondary market, just this concept of right process, right mindset, right structure. But we're not always going to do it right. We're going to make mistakes along the way. But actually what I have found and what I've been blessed with in this industry over the last 25 years is that there's some really good people in this industry. Good people with good intentions. And like, we're humans, so we're going to make mistakes along the way. But my big ask is for those that come into this market, you can be a good person and win. You don't have to rip people's faces off. And just having that mentality as you come into this, right process, right structure, right mindset, will allow this industry to grow even further. Because really, we're a solutions provider. We're injecting liquidity in another illiquid asset class. And I've benefited from meeting some incredible people in this industry that have really good intentions, and I really appreciate that.
Some really good people on this call. It's been such a pleasure having this conversation with you all, and I'll look forward to having this in the years to come on the march to $1 trillion.